blaming yourself when you win, blaming the market when you lose. One of the most common fallacies in investor psychology. There's a very common behavior in the investment world. When a profit comes, I did the right analysis. When a loss comes, the market is irrational. This is no coincidence. This behavior has a clear name in psychology. 1. Self-favoritism bias. Fritz Heider was one of the first to systematically study this concept. It has since been extensively studied in social psychology. Its definition is simple. People tend to attribute success to their own abilities and failure to external factors. In investing, this appears as follows. Profit. My analysis was strong. Loss. The Fed messed up. The algorithms manipulated it. There's manipulation. This fallacy protects the ego but damages performance. 2. Attribution error. Known as a fundamental attribution error in social psychology, this occurs when an individual incorrectly attributes the cause of an outcome. Lee Ross is a prominent figure in this field. An investor does the following. Attributes success to internal factors, intelligence, analysis, intuition. Attributes failure to external factors, market, economy, politics. This disrupts the learning process because if a mistake is not acknowledged, it cannot be corrected. 3. Overconfidence. This fallacy, frequently studied in behavioral finance literature, increases especially in bull markets. Daniel Kahneman and Amos Tversky have shown that people over-rely on their own predictions under uncertainty. In a rising market, the investor thinks, I've figured out the market. I've found my formula. I won't make mistakes anymore. But when a downturn comes, the same person thinks, this is irrational. A downturn like this doesn't make sense. However, most of the time, both gains and losses occur within the same system. 4. The illusion of control. The human brain loves the feeling of control. The investor feels in control when making a profit, assumes that control is external when incurring a loss. This is known as the illusion of control. In reality, the market is complex, highly volatile, and largely beyond our control. 5. Neurobiological dimension. In case of profit, dopamine increases. The brain activates the reward system. The feeling of, I did it right, intensifies. In case of loss, pain centers are activated. The defense mechanism kicks in. Blame is ejected. This biological defense mechanism provides psychological relief in the short term, but it hinders development in the long term. 6. The cost of this behavior. 1. Amplifying the wrong strategy. An investor who completely ties profit to skill increases risk. 2. Repeating mistakes. The system isn't corrected because the cause of the loss is attributed to external factors. 3. Losing the real risk perception. The investor becomes unable to measure their own mistakes. 4. Decreased learning capacity. This is the most dangerous. True development begins with the question, what was my share in this loss? 7. Why do professionals fall less into this trap? Successful investors keep a trading log. Record the decision-making process. Analyze the process, not the result. They know this. The right decision doesn't always bring profit. A wrong decision can sometimes bring profit. An investor who can make this distinction develops. 8. Psychological cycle. Profit comes, ego grows. Risk increases, the system loosens. Large loss occurs, the market is blamed. Learning doesn't happen, the cycle repeats. This cycle erodes the portfolio in the long run. 9. Way out. Separate process from outcome. A trade is not right just because it's profitable, nor wrong just because it's losing. Keep a decision log. Why did I buy? What was my risk? Under what conditions will I exit? Think statistically. Not just one trade, but 100 trades are important. Limit ego with system. If there is a system, ego stays in the background. Strong results. An investor who blames themselves when winning and the market when losing. Feels comfortable in the short term. Losses in the long term. Because you can't improve by blaming the market. True transformation begins with these sentences. How lucky was I when I won? What did I do wrong when I lost? A disciplined investor grows their system, not their ego.